You know that feeling when you walk past a store and see a massive crowd forming? Everyone's pushing to get inside. You can't see what they're buying, but something in your gut tells you. Whatever it is, it's important. That's exactly what's happening in the gold market right now. Except the crowd isn't retail investors. It isn't your neighbor or your coworker. It's central banks, the world's most powerful financial institutions. And they're not just buying gold. They're panic buying it at levels we haven't seen in over half a century. Let me show you what I mean. In the past 18 months, central banks have purchased over 2,000 tons of gold. To put that in perspective, that's more than the entire gold reserves of Germany, more than Italy, more than France. They've bought more gold in this short period than they did during the entire decade of the 1990s combined. But here's where it gets interesting. They're not just buying, they're accelerating. The pace of purchases has increased every single quarter. And when you look at who's buying, that's when the real story emerges. China's central bank has been adding gold to its reserves for 17 consecutive months. Not 1 month off. Not a pause. 17 months straight. But here's what they're not telling you. The official numbers from the People's Bank of China show they've added about 300 tons. Industry analysts believe the real number is closer to 1,000 tons. Why the discrepancy? Because China doesn't want to show their hand. They don't want the market to know how aggressively they're positioning. Poland just announced they're increasing their gold reserves by 100 tons. Singapore's central bank, which historically held almost no gold, has quietly accumulated significant positions. Turkey has been buying. India has been buying. Even smaller nations like Serbia and the Czech Republic are loading up. Now, you might be thinking, okay, so central banks are buying gold. They've always bought gold. What's different this time? Everything. See, there's a pattern to central bank gold buying. Historically, they buy during crises. They bought heavily in 2008 during the financial crisis. They bought in 2011 during the European debt crisis. They bought in 2020 during the pandemic. But right now, the stock market just hit all-time highs. Unemployment is relatively low. We're not in an obvious crisis. So why are they panic buying? Because they see something coming that we don't. Or more accurately, they see something coming that they're not telling us about. Let me take you back to 1971. August 15th, President Nixon goes on television and makes an announcement that changes the world forever. The United States is closing the gold window. No longer will foreign governments be able to exchange their dollars for gold. The dollar, for the first time in history, becomes a pure fiat currency backed by nothing but faith in the U.S. government. At the time, the official gold price was $35 an ounce. The U.S. Treasury held about 8,100 tons of gold. Foreign governments held dollars worth far more than the gold backing them. Nixon knew that if countries started demanding their gold, the entire system would collapse. So he changed the rules. What happened next? Gold went from $35 to $850 by 1980, a 2,400% increase in less than a decade. But here's what most people miss about that period. The smart money didn't wait for gold to hit $850. They bought when it was $40, $50, $100. They bought when everyone else was still trusting the system. The central banks buying today? They're the smart money. And they're not buying because gold is cheap. They're buying because they know what's coming. Let me show you the mechanics of what's actually happening right now. The COMEX, the major commodities exchange where gold futures are traded, has a problem. A big problem. For every ounce of physical gold in their vaults, there are approximately 100 ounces of paper gold being traded. These are futures contracts, ETFs, derivatives, essentially promises to deliver gold. But here's the thing about promises. They only work if everyone doesn't try to collect at the same time. Right now, we're seeing something unprecedented. The amount of gold standing for delivery, meaning people who are actually demanding physical metal instead of just rolling their contracts forward, has increased by over 300% in the past year. These aren't speculators. These are institutions, family offices, and sovereign wealth funds who want the actual metal. The COMEX has responded by changing their rules. They've increased margin requirements. They've adjusted delivery procedures. They've made it harder and more expensive to take physical delivery. Why? Because they're running out of gold to deliver. Now let's talk about what's happening in London at the LBMA, the London Bullion Market Association. This is where the world's gold is really traded, not the COMEX. The LBMA handles about 20 million ounces of gold per day. That's roughly $50 billion worth of gold changing hands daily. But here's what's fascinating. The LBMA operates on what's called an unallocated basis. When you buy gold through the LBMA, you don't actually own specific bars. You own a claim on gold that exists somewhere in the system. It's like a bank account. The bank doesn't keep your specific dollars in a vault with your name on them. They keep a pool of money and give you a claim on it. This works fine until everyone wants their gold at the same time. And that's exactly what's starting to happen. Allocated gold accounts where you own specific bars with serial numbers are seeing unprecedented demand. The premiums for allocated versus unallocated have widened significantly. People are willing to pay extra just to know their gold actually exists and isn't just a number on a screen. Here's a story that illustrates what's really going on. In 2013, Germany announced they wanted to repatriate 300 tons of gold stored at the Federal Reserve in New York. This was their gold. They owned it. They just wanted it moved from New York to Frankfurt. Simple request, right? The Federal Reserve told them it would take 7 years to move gold that supposedly was sitting in a vault. Germany eventually got their gold back, but the incident raised serious questions. Why would it take 7 years to move gold that's already there? Unless it wasn't actually there. Unless it had been leased out, or hypothecated, or was being used for other purposes. This is why central banks are buying physical gold and storing it in their own vaults. They don't trust the system anymore. They don't trust that the gold they think they own actually exists in the form they think it exists. Now, let me connect this to something that's happening right now that most people aren't paying attention to. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, are working on an alternative to the dollar-based financial system. They're not being subtle about it. They've explicitly stated their goal is to reduce dependence on the US dollar. How do you create an alternative to the dollar? You need something to back your currency, something that has universal value, something that can't be printed or manipulated, something like gold. China and Russia have been accumulating gold for years in preparation for this. They're not buying gold because they think it's going to go up 20% or 30%. They're buying gold because they're building a parallel financial system. And when that system launches, when there's a credible alternative to the dollar, the entire game changes. Think about what happens when countries have a choice. Right now, if you're a country that wants to trade internationally, you need dollars. You need to hold US Treasury bonds. You need to play by US rules. But what if you didn't? What if you could trade in a currency backed by gold? What if you could settle transactions without going through the US banking system? Suddenly, all those dollars that countries are holding, all those treasury bonds, they're not as necessary anymore. And when something becomes less necessary, its value decreases. This is the real panic buy signal. Central banks aren't buying gold because they think it's undervalued. They're buying gold because they're preparing for a fundamental restructuring of the global financial system. Let me give you some specific numbers that show how dramatic this shift is. In 2000, central banks were net sellers of gold. They sold about 400 tons that year. The prevailing wisdom was that gold was a barbarous relic, an outdated asset that had no place in modern central banking. Countries like the UK sold half their gold reserves at around $275 an ounce. Gordon Brown, the Chancellor of the Exchequer at the time, thought he was being smart, modernizing Britain's reserves. That decision is now known as Brown's bottom because he sold at almost the exact low of the market. That gold would be worth over $10 billion more today if they'd kept it. But here's what's important. From 2000 to 2010, central banks continued to be net sellers. Then something changed. In 2010, they became net buyers. And they've been net buyers every single year since. But the pace of buying has accelerated dramatically in the past 2 years. Why 2010? What changed? That was right after the 2008 financial crisis. Central banks saw what happened when the financial system nearly collapsed. They saw how quickly confidence can evaporate. They saw how the US Federal Reserve printed trillions of dollars to save the banking system. And they realized, we need an asset that can't be printed. We need an insurance policy. Now, let's talk about something that affects you directly. Your retirement accounts, your savings, your purchasing power. Most people have their retirement savings in stocks, bonds, maybe some real estate. These are all dollar-denominated assets. When the dollar loses value, these assets might go up in nominal terms, but they're losing purchasing power. You might have more dollars, but those dollars buy less. Here's a quick aside, and this is important if you're sitting on $100,000 or more in retirement accounts. I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. It's worth checking out if you're concerned about protecting your purchasing power. I'm not saying you should move everything into gold, but having some exposure as insurance makes sense given what we're seeing. Anyway, back to what's happening in the market right now. The gold price has been consolidating in a range for the past few months. It's been bouncing between $2,600 and $2,700 an ounce. On the surface, this looks like indecision, like the market doesn't know which way to go. But when you look under the hood, when you see what's actually happening with physical demand, with central bank buying, with the supply situation, this consolidation is a coiled spring. Let me explain the supply side because this is critical. Gold production peaked in 2018 at about 3,300 tons per year. Since then, it's been flat to declining. The easy gold has been mined. The high-grade deposits are depleted. New discoveries are rare and expensive to develop. It takes 10 to 15 years from discovery to production for a new gold mine. Meanwhile, demand has increased. Central banks are buying 1,000 plus tons per year. Jewelry demand, particularly from India and China, remains strong. Industrial demand for gold in electronics and technology is growing. And now, we're seeing a resurgence in investment demand as people wake up to what's happening. You've got declining supply and increasing demand. Economics 101 tells you what happens next. But there's a lag. There's always a lag between when the smart money positions and when the price reflects reality. Here's another historical parallel that's instructive. In 2008, during the financial crisis, gold initially dropped. It went from $1,000 to $700. People were selling everything, including gold, to raise cash. But the smart money was buying that dip because they knew what was coming. They knew the Federal Reserve would print trillions. They knew governments would run massive deficits. They knew the dollar would be debased. Gold bottomed in October 2008 at $700. By September 2011, it hit $1,900, a 170% gain in less than 3 years. But again, the smart money didn't buy at $1,900. They bought at $700, $800, $900. They bought when everyone else was panicking. Right now, we're in a similar setup. The market looks calm on the surface. But underneath, the smart money, the central banks, the institutions that have access to information we don't, they're accumulating aggressively. Let me show you what's happening with the mining stocks, because this tells you something important about where we are in the cycle. The gold mining stocks, measured by indices like the GDX, have been underperforming gold itself. Normally, mining stocks are leveraged plays on gold. When gold goes up 10%, mining stocks might go up 20% or 30%. But right now, gold is near all-time highs, and mining stocks are lagging. Why? Because the market doesn't believe the gold price is sustainable. The market thinks gold will come back down, so investors aren't willing to pay up for mining stocks. But here's what history shows. When mining stocks start to outperform gold, when that ratio starts to shift, that's when the real move begins. That's when the market starts to believe. That's when retail investors pile in. That's when gold goes from 2,700 to 3,000 to 4,000, to levels that seem impossible right now. We're not there yet, but we're getting close. And the central banks buying now? They're not waiting for confirmation. They're positioning before the crowd realizes what's happening. Now let's talk about the dollar itself, because this is the other side of the equation. Gold doesn't exist in a vacuum. It's priced in dollars. When the dollar weakens, gold typically rises. When the dollar strengthens, gold typically falls. The US dollar index, which measures the dollar against a basket of other currencies, has been strong for the past few years. This has kept a lid on gold prices. But there are cracks forming in dollar strength. The US national debt just crossed $36 trillion. That's trillion with a T. The interest payments on that debt are now over $1 trillion per year. That's more than the defense budget, more than Medicare. The US is paying more in interest than it spends on any single government program. How do you service that debt? You have two options. You either raise taxes dramatically, which is politically impossible, or you print money. And when you print money, you debase the currency. You make every existing dollar worth less. The Federal Reserve has already shown they're willing to print unlimited amounts of money when the system is threatened. They did it in 2008. They did it in 2020. They'll do it again when the next crisis hits. And every time they do it, gold becomes more valuable in dollar terms. But here's what's different this time. In 2008 and 2020, the Fed could print money because inflation was low. They had room to maneuver. Right now, inflation is still elevated. The Fed is in a box. If they print money to solve the next crisis, inflation could spiral out of control. If they don't print money, the financial system could collapse. This is why central banks are buying gold. They see the box the Fed is in. They see the impossible choices ahead, and they're preparing for both scenarios. If the Fed prints, gold goes up. If the Fed doesn't print and the system crashes, gold goes up. Either way, gold is the insurance policy. Let me give you another specific example of what's happening right now. The Shanghai Gold Exchange, which is the primary gold market in China, has been trading at a premium to London and New York prices. This premium, called the Shanghai Premium, has been widening. At times, it's been $30 to $50 per ounce higher than Western prices. What does this tell you? It tells you there's more demand for physical gold in China than there is supply. It tells you Chinese buyers are willing to pay more to get actual metal. And remember, China is the world's largest gold producer and the world's largest gold consumer. If they're running a premium, that's a signal that physical gold is tight globally. Now combine this with what's happening in India, the other major gold market. India's gold imports have been surging. Despite high prices, despite import duties, Indian buyers are accumulating. Why? Because they have thousands of years of cultural memory about the value of gold. They've seen empires rise and fall. They've seen currencies come and go. Gold has always maintained its value. Western investors have largely forgotten this. We've been conditioned to believe that stocks always go up, that the dollar is stable, that the system is safe. But the rest of the world hasn't forgotten, and they're acting accordingly. Here's something else that's happening that most people aren't aware of. The gold lease rates, which is the cost to borrow gold, have been spiking. When lease rates spike, it means there's a shortage of physical gold available to borrow. Banks and institutions that need gold for various purposes are having to pay more to get it. This is a technical indicator, but it's important. It shows stress in the physical market. It shows that despite the paper price being relatively stable, the physical market is tight. Now, let me address something that skeptics always bring up. They say, gold doesn't pay interest. It doesn't pay dividends. It just sits there. Why would I own it? This is the wrong way to think about gold. Gold isn't an investment. It's insurance. It's a store of value. When you buy insurance on your house, you don't expect it to pay dividends. You expect it to protect you if something goes wrong. Gold is insurance against monetary chaos, against currency debasement, against the failure of the financial system. And right now, the cost of that insurance is relatively cheap compared to the risk. Think about it this way. If you have $500,000 in retirement savings, all in stocks and bonds, all denominated in dollars, you're taking a massive bet that the dollar remains stable, that the financial system remains intact, that governments don't make catastrophic policy mistakes. Is that a bet you want to make with 100% of your savings? Or does it make sense to have 10%, 20%, maybe 30% in an asset that has maintained its value for 5,000 years? An asset that central banks are panic buying right now? Let me tell you about what happened in Venezuela. In 2013, Venezuela was a relatively prosperous country. They had oil wealth. They had a functioning economy. The bolivar, their currency, was stable. If you had told someone in Venezuela in 2013 that within 5 years their currency would be worthless, that they'd be using wheelbarrows of cash to buy bread, they would have laughed at you. But that's exactly what happened. The government printed money to fund spending. Inflation started to rise. Then it accelerated. Then it spiraled out of control. By 2018, Venezuela had hyperinflation. The currency became worthless. People's life savings evaporated. But you know who didn't lose everything? The people who had gold. The people who had converted some of their bolivars into gold when things were still relatively normal. They were able to preserve their wealth. They were able to escape. They were able to start over. Now, I'm not saying the U.S. is going to become Venezuela. The U.S. dollar is the world's reserve currency. The U.S. has the largest economy and the strongest military. But the principles are the same. When governments print too much money, when debt becomes unsustainable, when confidence is lost, currencies fail. It's happened throughout history. It's happened to every fiat currency that's ever existed. The average lifespan of a fiat currency is 27 years. The dollar has been a pure fiat currency since 1971. That's 54 years. We're already well past the average. And the stresses on the dollar are greater now than they've ever been. This is what central banks see. This is why they're buying gold at a pace we haven't seen in generations. They're not buying because they think gold is going to go up 20%. They're buying because they're preparing for a potential currency crisis. Now, let's talk about timing, because this is what everyone wants to know. When is this going to happen? When is gold going to break out? The honest answer is, I don't know. Nobody knows. Markets can remain irrational longer than you can remain solvent, as the saying goes. But what I can tell you is that the setup is there. The fundamentals are there. The smart money is positioning. And when the move comes, it's going to be fast. In 2019, gold was trading around $1,400. By August 2020, it hit $2,070. That's a 48% move in about a year. But most of that move happened in the final 3 months. Gold went from $1,700 to $2,070 in just 90 days. If you waited for confirmation, if you waited to see the move before you bought, you missed most of it. The same thing happened in 2008 to 2011. Gold consolidated for months, frustrating investors who had bought early. Then suddenly, it took off. From $1,000 to $1,900 in less than 3 years, with most of the gains coming in explosive bursts. This is how gold moves. It's not a steady climb. It's long periods of consolidation, followed by explosive moves higher. And we're in one of those consolidation periods right now. But the longer it consolidates, the bigger the move when it comes. Here's what I'm watching for. I'm watching the dollar index. If it breaks below key support levels, that's a signal. I'm watching the 10-year Treasury yield. If it starts to spike, indicating that investors are demanding higher returns to hold U.S. debt, that's a signal. I'm watching the gold mining stocks. When they start to outperform gold itself, that's a signal. And I'm watching central bank buying. As long as they're accumulating at this pace, the message is clear. But here's the thing about signals. By the time everyone sees them, it's too late. The smart money doesn't wait for confirmation. They position before the crowd realizes what's happening. Think about the people who bought Bitcoin at $100, or $1,000, or even $10,000. They didn't wait for Bitcoin to hit $60,000 to validate their thesis. They bought when it was controversial, when people were skeptical, when the mainstream media was calling it a bubble. And they made life-changing returns. Gold is different from Bitcoin. It's been around for thousands of years. It's not speculative. It's not going to give you 100 times returns. But it's also not going to go to zero. It's the ultimate safe haven. And right now, the ultimate safe haven is being accumulated by the world's most sophisticated buyers at a pace that suggests they know something we don't. Let me leave you with this final thought. In 1971, when Nixon closed the gold window, the U.S. held about 8,100 tons of gold. Today, the U.S. still officially holds about 8,100 tons. That number hasn't changed in over 50 years, but the amount of dollars in circulation has increased by over 2,000%. The U.S. money supply has exploded, but the gold backing it hasn't increased at all. This means that each ounce of gold is backing far more dollars than it did in 1971. If you were to back the current money supply with gold at the same ratio as 1971, gold would need to be priced at over $20,000 per ounce. Now, I'm not saying gold is going to $20,000 tomorrow, but it illustrates how undervalued gold is relative to the amount of currency that's been created. Central banks understand this math. They understand that gold is the only asset that can't be printed, that can't be debased, that maintains its value regardless of what governments do. And they're acting on that understanding right now. The panic buy signal isn't coming from retail investors. It's not coming from gold bugs or conspiracy theorists. It's coming from the world's central banks. The institutions that have access to information we don't. The institutions that are responsible for managing entire nations' reserves. They're buying gold at the fastest pace in modern history. That's not a signal to ignore. That's a signal to act on, because when central banks panic buy, they're not doing it for fun. They're not doing it because they think gold is a good trade. They're doing it because they see a storm coming, and they're preparing. The question is, are you